All right, guys. So we're not going to waste any time with this. We're going to get right into market structure, right? Market structure is pretty much just the visual representation of how the market moves. All right. And this is going to be important as you start to hear more about the scanner and what everything is being done. This is going to help you get a clear understanding of why a buy is called where it's called, why a sell is called where it's called. All right. So I will be showing trading view, and I'm going to start with just drawing some lines on the screen using arrows and keep it very, very, very simple. All right, so just confirm that you are seeing my screen, and then we're going to take it from there. Where's the chat? All right, perfect. Cool. All right, so in the world of trading, and we are retail traders, there is a pattern that exists every single time. All right. Well, we are buying and when we're selling. When we're buying, it's going to look one way. When we're selling, it's going to look like the opposite. It's going in the opposite direction. All right. And just like when we would have been in primary school, we would have learned how to recognize shapes, recognize letters, and all that. The more you see this pattern, the more you're going to understand what's happening. And on the left, let me just label these. On the left, this is if we were buying, if price is increasing in value. And on the right, this is if we're selling. Or the trading term for sell is going to be bearish. All right. And for a buy, this is going to be bullish. Okay. Bullish if price is going up, bearish if price is coming down. For the sake of this conversation, we are just going to be talking about, why is this not deleting? We're just going to be talking about the bullish side of things, right? Just so we could get that cleared up. Now, while before to segue into this, I gotta tell you about how the market moves. Market moves in three ways, right? It's either going to go up, which is bullish. It's going to come down, which is bearish, and then it moves sideways. All right. It doesn't move in a straight line, but when it says sideways, it's just not giving us any new highs or new lows. It just seems to be moving this way as opposed to going upwards or downwards. All right. Those are the three ways that the market moves: up, down, sideways. That is it. There's no other direction. Those are just the three ways that the market moves. And this is the simple version. Whenever we are, actually, let me tell you the structure of this move itself. So this is called an A, B, C, D pattern. Where's my type tool? Text. All right. A, B, C, D. Now, what I'm about to tell you right now, within, I guess, 4 minutes of being in this room, is whenever we're placing a buy, we are going to place that buy at C. Whenever a trade is called on the scanner, it's most likely at C. All right. That's the first thing. That is the oversimplification of this whole game of trading. All you guys are learning, are looking to learn, is how to figure out when C shows up. That is it. All right. Because this is where you want to buy. Now, there are a few ways that this works out. First being that this pattern has three phases to it. All right. So this bullish pattern has a first phase, which is from A to B. This is called the impulsive phase. This is when price makes a sudden move in that up in a given direction. Because we're talking about buys, it's all about going up, right? So it's a sudden move going up, A to B. The second phase is called the correction, or you can call it a retest, or you can call it a pullback. And then the last one is called the continuation. So these three phases, they're going to, wait a minute. Someone had a question or no? I thought I heard someone. All right. So with this one pattern, it has these three phases, the impulse, the correction, and the continuation. All right. I'm just going to put this as correction just for the sake of the conversation. Just these three. And we need to know these three so that we know where we are when we're looking at the chart, right? We're trying to figure out if we could buy or not. So if we knew, right? If you knew for sure that you only want to place a buy at C, C happens at the end of the correction phase. And it is between C and D during the continuation phase. That's where we make our money. Okay. So anytime we're placing a buy, we are making our money during the C to D phase. We let A and B happen. We wait for C to show up, and then we buy at C so we can make money on the way to D. Type of A, see if that seems clear. A, C, if it's clear. All right. If you are lost, let me know that you're lost, because this is the perfect time to be lost. All right. Cool. A lot of ACs coming through. All right. So this is all we're looking for. And because we know that this pattern exists, right? We know what to look for. So if you came on a chart and you saw this happen, right? If you come on the chart at this point, right? Price started here, it went up, and it started to come down. So far, we have, right? We got A for sure. We have B. And for just looking at the chart for now, you could say that we have C. You could say that. Now, the thing about C, C is the end of this correction happening, right? C is the end. But it's hard to tell in real time when C is going to turn up. All right? It's hard to tell. That's why you guys are learning, right? Because we want to be able to identify this. Because if you knew when it was going to turn up, everybody in the market will be making money coming and going. All right? But as price is moving, you got to be able to figure it out. Like, how do we know when this happens? So a few things. First thing that you could write down is C turns up based on, I'm going to say a term now, and it's okay if you don't know what it is, but I just want to say the term so that you have it in your notes. C sometimes turns up based on an imbalance that occurred during A and B. I'm going to show you what that looks like on the chart eventually. But for now, C shows up based on an imbalance that happened at A and B. Let's imagine for a second, this is us, real life situation. Have any of you ever experienced something where you've been learning something for a period of time, right? It could have been you are at a job, right? You've been doing great at that job, you got a promotion. During the promotion now, because you were good at what you were doing before, you were great. That's why you got recognized in the first place. You got that promotion, and then suddenly you kind of feel like with the new responsibilities that you have, you don't feel as confident as you did when you had the other position, right? You feel like you're missing some things. And maybe the way that you were moving in your standards feels like it dropped a little bit. Has that ever happened to anybody? This could be in learning something new. This could be at a job setting. This could be anything like that. But you were going great. and then you got a bit more responsibility or something, and it kind of feels like you set back a little bit. No? Just me? Okay. All right, no worries. All right, cool. Somebody knows what I'm talking about, right? So there's that. Or it could be you've been going through life. I don't know if anybody has done any like introspection, journaling, that sort of thing, therapy, and it feels like there's something in your past that you haven't really got over before, and you had to revisit that thing. When you revisited it, you got closure, you settled on what that was before, and then you were able to move forward. You know what I mean? That's like something real. That that is the imbalance. That area, that thing that was like unfinished business, that is what the market also does. And when the market does it, it shows up in the impulsive phase. While things are going up between A and B, those gaps start to show up. And those gaps are what we look for as traders. Why? Because the market likes to rebalance itself. All right. And let's talk about that. That's why it's moving up and down. So here in the market, when we talk about the market here in trading, when we talk about the market being imbalanced, it's usually when the correction is about 50%. All right. So if price goes up, it corrects about 50% and then it goes up, corrects about 50%, goes up, corrects about 50%. And then it keeps going like this. This right here that I just drew, this is what we called a trend. And specifically, this is a bullish trend. Why? When you look at it, you can tell that price started at the bottom and ended at the top. It was moving upwards. A trend is made up of a bunch of this pattern that I just showed you repeating itself one after the other. All right. And each time is going to give you that 50%, at least 50% correction. All right. So you guys, I'm sure people on here, has anyone ever shopped during Black Friday? All right. Have you ever bought anything during Black Friday? Have you ever knew Black Friday was coming up and decided, you know what? Black Friday is 2 weeks away. I will not buy anything right now. I'm going to wait until Black Friday comes in order to make that purchase. All right. We do it all the time. My question is why? Why do you wait until Black Friday to buy the things that you were going to buy? Discounts, right? Sales. It's a better price. It's the same thing with trading. All right. When we are looking for our entries, you're looking for a discounted price. And that discounted price, like, all right, what is a good discount for you guys? Tell me, what percentage is a good discount for you? 50%? If you had to choose, not what do people give you. If you had to choose 50% off, nobody want 90%. Yeah. Anything, any discount bigger than 50% is phenomenal, right? That is great. And we are looking for the same thing. We're looking for the same thing. So here, like I was mentioning, boy. All right, let's find where we were. Come on now. All right. Right. So just like I mentioned with life, me going to get about that unfinished business, price goes up. You come back down, we get that retracement. Anything 50% or more of a discount is what we're looking for. That means that's great places for us to enter. That gives us the range that our C could potentially show up in. All right, that's what we're paying attention to. So we have this 50%, and then anything 50% to 100% off is where we would want to place a buy. If for whatever reason price came up and we got the correction and it only came to 40%, we're not really interested in that, right? Just from a simple economic standpoint. If you bought something for $100, right? Or if something was valued at $100, if you were going to buy it, you don't want to buy it at 80. You don't want to buy it at 60. You would rather buy that at 30. If you bought the thing that was valued at 100, you bought it at 30, then if you turn around and sold it for 100, you make $70. If you could sell it for more than 100, even better. We get the discounts because it gives us more room for profit. So in any of those mixed classes that we would have with Kai, what he would mention is we um we always try to get the best price possible. So if you're looking for a buy, we want to buy as low as possible. No problem, Tom. All right. So we want to buy as low as possible. So we're waiting for price to get as low as possible. And like I mentioned, those areas of imbalance, those trauma areas that the market leaves are those targets. So sometimes you might have this unfinished business might be here. There might be unfinished business right there. There might even be unfinished business right here, right? And the market could decide to just come to this point and continue pushing. Come here, continue pushing. Come here, continue pushing. All right. So sometimes, if any of you have the scanner, you might see a setup. Price doesn't come to exactly where we're looking to enter, but it goes a bit higher and it keeps going. Why? That thing was not so painful that price had to come all the way down here to revisit it. It just needed to take a quick breather. All right. So it was in its flow. It kept going. It's momentum. All right. So maybe it was running really fast and it was like, you know what? All right, cool. Let me go again. But when you run long enough, for a long enough period of time, like if all of these came above 50%, and I'll see if I can find out on an actual chart, what happens is you've been running for so long, for so fast, for so long that the time that you need to rest now that you didn't rest before, you need a lot more time to rest. Does that make sense? I know we're talking about trading, but I want you to, I'm a visual learner, so I tend to talk in images. Like there's that metaphor about the guy that's cutting wood, like two people are cutting trees in a forest, and one guy keeps cutting trees. The other guy cuts a tree, sharpens the axe. Cuts a tree, sharpens the axe. Cuts the tree, sharpens the axe. The first guy that would kept cutting, he would have been ahead out front at first. But while he's cutting back to back trees, his axe is getting dull. While the other guy cuts one tree, sharpens the axe, cuts another tree. Every time he gets a tree, he's facing it with a brand new sharpened axe. That, my friends, is just this. Cuts one tree. Then he takes the time to sharpen the axe. Cuts another tree. Takes the time to sharpen the axe. All right. He is spending time allowing that correction to happen. The correction is just sharpening the axe. All right. So that's enough metaphors for now. So what do we know so far? There is one pattern that exists. This is A, B, C, D. We also know that we buy at C. We know that in order to, that C that we're looking for is 50% or less. So that gives us the general area that we're looking at, right? When price makes a correction that's 50%, 50% discount or more, that's when we are going to look for our entries. And this pattern, when it repeats itself several times, is going to create something called a trend. And we always trade the trend. So if we're in a bullish trend, we're only going to look for buys. And in those buys, we are only going to buy at C. So let me show you this right here, and then we're going to jump onto a chart and kind of make this make some sense. All right, so as price is doing this, we would buy in there, in there. All right, because you would have heard this before, buy low, sell high. Buy low, sell high. That's what we're going to do. Always buy at C. All right, so let's see if we can make this make some sense. All right, we are on a 15-minute time frame. The pair we're looking at is GN, all right? The Great Britain pound to the New Zealand dollar. I know we do a lot of stuff on gold, but I wanted to show you a different currency so you can get an idea. So now, for all the marks in the class, just by looking at what we have here, all right? Price was down here, and it ended up here. Based on what I just told you, what kind of trend do you think we're in? Is price going up or is price going down? Uptrend. All right, cool. We're in a bullish trend. Yeah, bullish trend. Price is going up. And if you're in a bullish trend, are we looking for buys or are we looking for sells? We're looking for buys. All right, good stuff. So here we go. We know that the trend overall is bullish. All right, so here's what we're going to do. We got to figure out, we're just going to get a starting point, okay? So the starting point is going to be the last low point. So let's say this is the lowest point here. I'm just going to do this kind of broad strokes rather than getting too detailed. So if this is the lowest point, right? This is the lowest point right now, and then this will be the highest point here. Right? Just in this area, this is the lowest point, this is the highest point, which means price would have started at here at some point and came up here. So this is A, this is B. Oh, shoot, I forgot something real quick. Let me show you this real quick. As we're talking about the trend, because this is going to be important for this part that we're talking about on the chart. The trend also has a structure, right? You're in a bullish trend if you get higher highs and higher lows. So it's always going to start at a low. After the low, we get a high. When price comes down, this one is called a higher low. This is a higher low because this low is higher than this low. All right, all clear? This is a higher low because it's higher than the previous low. This high is called a higher high because it's higher than the previous high. This is a higher low. This is a higher high. Come on, sir. Higher high. What is this called? Higher low. Fantastic. Now, let me see if you've been putting things together. Look at your notes. Look at the pattern that I showed you that exists everywhere. All right. Write this in the trend. This is the higher highs and higher lows. All right. If this on the pattern that I showed you exists everywhere is C, because we only buy at C. Where do you think we buy from based on the trend and the structure that I told you about a trend? All right, cool. So C in the pattern is actually the higher low in a trend. So we always buy from the higher low. All right, good stuff. So let's do this. Remember, it's A, B, C. All right, so we got this is A, this is B. This right here, because this is now before before price went up. We then got, what is going on? This as the next low. And this low is higher than the previous low. And then we went, all right, let's not complicate. We went up to here. So it's not as pretty as what I showed you before, but this is A, this is B, this is C, this is D. Okay, let's take a look. A to B. C is this white line. The orange line is 50%. Is C 50% or 50% or greater? All right, the orange line is 50%. The white line is the low, right? Yeah, so we got a greater discount. So yeah, this is an area that we would have placed a buy in. All right, now the next thing, because I mentioned C shows up around the area of imbalance. So the question now is, that's all right, Tomo. The question now is, what does imbalance actually look like? All right, so I'm gonna need to draw you guys another picture. Hey, Kiana, you had a question? Did you have a question? Nope. Okay. All right, so I need to show you guys what imbalance shows up as, so we can identify it when we get back to the chart. All right, so what we're going to have here are some candlesticks. Green is going to represent price going up, and red is going to represent price going down. So let me show you this real quick. We're going to use 3 candles to show what I'm talking about. All right. So a couple things. This, what I just drew on the screen, this is the same thing as price came up to here, down to here. All right. This is the same thing as this. Green candles represent A to B. B to C is when price decreased in value. So we're going to get some red candles. And then going back up is more green candles. Okay. So the candlestick actually has these 3 parts where there's a body, which is this big rectangle area. But then there's going to be what we call a wick. And we call them candlesticks because they're actually Japanese candlesticks. And those guys have wicks on both ends. All right. Now, here's what a wick represents. I know like it feels like I'm going all over the place, but I got to show you guys this in parts. When a green candle forms, all right, it starts flat and then it goes up. As price increases, you then get this body that takes shape. So if at the bottom here, let's see, if at the bottom here was 0 and the top here is $10, well, yeah, and the top was 10. That means that price started at 0 and it increased all the way up to 10. All right. That's the first thing about the candle. If it started at 0 and ended at 10, great. It's going to be solid at the top. If price started at 0, went to 10, but then actually stopped at 8, you're going to get a wick at the top of it. All the wick does is there to tell you that price was here, but it didn't stay there. All right. It's a lot like if you were leaving home to go to the supermarket but you decided to stop at a gas station first. Your destination was the supermarket. You made another stop along the way, right? That's your wick. In the story, you don't have to tell people you went to the gas station. Just like I left home and I went to the supermarket. End of story. But the charts are going to show the fact that you left home, you went to the gas station, stopped at the supermarket. Cool. Imbalance occurs where you have three candles, but and they're wicks, they're always wicks involved in these situations. But if the body of the candles do not touch, if the wicks of the candles do not touch, then there is a gap, right? I'm going to show you here. So price went up, came back down, closed here. And oh, when a candle when a bullish candle opens, it always opens at where the last one closed. Okay? So this is going to go up to here. And then this candle forms, starting from the top. Maybe it went down first. And then, all right, so let's draw this properly. Started here, even, it came down first, and then it went back up and closed here. So since it came down, I got to put a wick. So when I talk about three candles, we're going to count 1, 2, 3. And if there is a space, right? If this wick and this wick, that if they don't, between those three candles, if those wicks don't intersect, then there's a gap. So it would look like this. If this happened, then this right here, this area right there, that would be your gap. Oh, wait, you can't see that. All right, that would be the gap. All right. Let me know if that's clear. Or if you need me to show you something else, I can show you it again. Well, I'll show you on a chart. All right. So we're looking at here. 1, 2, 3. Actually, let me make this bigger. All right, Lenovo, I will show you right here. All right, so 1, 2, 3. This wick, there's this tiny little gap right there. All right, but it's tiny. 1, 2, 3. There's no gaps here, so that's fine. 1, 2, 3. Tiny little gap. But what happened? This came down here and kind of filled that gap, right? Then we have 1, 2, 3. What do we have? We have a gap right here. And Lenovo, let me know if it's looking a little clearer. And then let's see, we did these three just now. And then 1, 2, 3. You can clearly see there is a gap right here. Lots of unfinished business right here. All right. So as we are trading these markets, these imbalances, they become targets, right? Because price likes to do two things. It needs to seek and destroy. When I say seek and destroy, it's going to look for imbalances and run towards them, or it's going to rebalance. They're similar, but they do slightly different things, right? For now, we're only focusing on the balance inside of things. No worry. No worries. Let me just change your name for you real quick. All right. So continue last, replay, start new. Yes. Where did my mouse go? All right. All right. We're just gonna go back in time a little bit. What? What is actually happening right now? Sorry, guys. Got my trading view is doing some weird stuff. Like I'm supposed to see things on my screen that I'm not actually seeing. Anyway. All right. So we are looking at this chart. Let's get rid of that. And let's get rid of this white line. So as we look at this, we know that we have A and B, and we have this imbalance that's here, right? These are areas that we would love to see price come back to and deal with what's happening in those spaces. All right, we need price to trade back into these areas before it goes up. And so as we watch, price comes down, and when you see the candlesticks coming down into this area, we like to call it, they're filling the gap, right? And that's just so we don't have something like this that just exists without the balancing of cells happening. So this really long thing happened one time. If you just look from here up, right? We saw price shoot all the way up there, and then it took its time and kind of come down like this, which is what you like to see. And then from there, it decided to move up. All right. So even looking at this right now, it's not as clean as the example as what I showed you before, right? But this A, B, C, D is the same thing as what we're looking here, even though it looks kind of crazy in the middle. All right. And the C that we're looking for was 50% or less. So again, if we use just this section, all right. So the part that we're ignoring is this part above in the blue area, and we're looking into this space down here. And what happened when price got into this area, we actually saw that it started to react, and then price kind of went up from there. Now, I'm going to share something else with you that's going to sound annoyingly simple, but I just want you to work with me here. C shows up, or the higher low shows up when price stops going down. If you're looking for this, A, B. From B to C, price is going down. C is going to show up when price stops going down and it starts going up. That's the oversimplification of it. Okay. Now, what this is going to look like in theory is, how do you know when price is going up? We spoke about it earlier. This series of higher highs and higher lows tells us that price is going up. That's an uptrend. So what I'm saying is, and I'm going to say it slow, maybe a couple times. We buy at C. C is the higher low. C is this right here, this area. But in order to identify C, we need to see an uptrend start to form at C? Let me know if you feel completely lost or are very, very confused. Let me know. If you're confused, put C in the chat. But the oversimplification is the higher low shows up when price stops going down. Okay? We will know price stops going down when it starts to go up again. We know that it's going up when it starts to give us higher highs and higher lows at C. All right. So no one is confused. Everyone understands. Francine, I see you processing over there. So what if we do not have the imbalance? Don't worry. If you don't have the imbalance, then you're still going to be looking for the area where price stops going down. All right. So let me show you what that looks like. All right. Let me show you what this looks like using these arrows. All right. So remember, when price starts to go up, we're going to get higher highs and higher lows. All right. Cool. So let's draw this fairly big. This is what our ABCD is doing. All right. Let's make that fatter and a little darker. Now, what we want is, remember, B to C, right? B to C in reality is not a straight line. B to C is, right? The same way when we're going up, price gives us higher highs and higher lows. When we're going down, we get lower lows and lower highs. So this is what's happening when price is going down. All right. Lower lows and lower highs. Lower lows and lower highs when price is going down. We will know price stops going down when we no longer get, let me label this. This is a lower high. This is a lower low, lower high, lower low, lower high. Oops. This is a lower low. Here's what I mean. When from here, if price goes up and we do not get a lower high, but instead we get a price does this, is this high lower than this high? That's the first question. Is this high lower than this one? No. Okay. All right. So flow with me. As long as we keep getting lower lows and lower highs, we are going down. If for whatever reason we stop getting lower lows and lower highs, are we still going down? Or is something changing? All right. Don't try to overthink it. Just answer the question. Lower lows and lower highs mean that we are going down. If one of those things changes, then something has changed. We have not fully changed direction, but something has changed. All right. So here's what happens. This lower low, and now we have a high. Let's turn that green. Boom. All right. Now we have a high. All right. Now that we have a high, if we are hoping that this changes direction, What do we want to see next? We hope that we hope that we get this because we want price to go up. All right. So we start at a low, we get a high. What do we want? Yeah. All right. Not a higher high just yet because we're looking for what's happening down here, right? We're at the bottom, right? Because right now we have a high, but if price comes down here and gives us a lower low, then it may make us keep going down. If we are hoping that this changes direction and goes up, we want this low to be a higher low. All right. So let's just back up a bit. Once we keep getting these lower highs and lower lows, we're going down. The moment instead of a lower high, we get a high, something has changed. We're not going up as yet, but we got to pay attention. If the next thing that we get is a higher low, then you could be more confident that, hey, we are more likely, this is more like 70%, 80%, we should be going up. If after this higher low, we then get a higher high, then yes, absolutely, we are now going up. We just changed direction. All right. I'm going to show you that if anyone here has ever been in the front seat of a car while it's driving, I'm going to show you how we can connect these dots and show you that you consider these things before you make that move. Right now, we're talking about when we're going to wait for when we buy. But if you came to a major stop, you driving, right? This is you driving. You driving, taking your time. You come to a major stop. You're in no rush. Someone is on the main road. Do I need to draw this? I don't need to draw this. You come to the major stop and I actually do need to draw this. Right, give me one sec. And I will actually, this is the last thing that I'm going to do, but this should make some sense. I'm in Barbados, so we drive on the left-hand side of the road. All right, so here's what we do. This car, this car is driving this way, all right? We want to go this direction. We want to do this. We want to make this turn, all right? This car is coming. If you are here and you are in no rush at all, if this car is just driving, are you going to pull out or are you going to just wait where you are? First question.
Wait.
You're going to wait. Awesome. Cool. So while this car is coming, all right, I'm going to do two of these at the same time. A and B already happened. Right now, you're at B. All right. You waiting here is B. This car coming is like B going towards C. Okay. When we actually get the confirmation that we can turn, that is when we are at C and we placed our buy for the continuation. All right. Those are the steps. If this car turns on its indicator right here, hey, if this car turns on this indicator, are you going to pull out. It's right here. The card is only here. It's still moving at the pace that it was moving at, but if it turned on an indicator, are you going to pull out or are you still going to wait?
Wait.
Cool. You're going to wait. But now you have more information. Before the indicator, you would assume this car is just going to drive right by you. Because it turned on its indicator, you're now like, okay, this car is more than likely going to make this turn. Cool. That, my friends, when the car puts on its indicator, that is, you remember I showed you that. Let me see how to do this. All right, I need to draw this again. Down, 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 lower, low. Boom. This car putting on the indicator is this part of the trend, right? Where we were getting those lower lows and lower highs, and then all of a sudden something changed. Okay? When something changed, it has our attention, but we're not moving yet. All right. So this car, you could then notice that the car is slowing down. The indicator is still on because I can't move two of these at the same time. So the car starts to slow down. You could visibly see it slowing down. All right. It has not started the turn as yet. It only started to slow down. Are you going to pull out? Are you still going to wait? Just to be sure that this was an accident. The person driving the hand accidentally hit the indicator. You're still going to wait. But you now have a second confirmation. You're like, this person is more than likely looking to turn because I could see that the car is slowing down. That slowing down of the car is now you getting that higher low, right? So then when the car comes, it comes to a very slow move and it what's the word? It commits to making the turn. When the car commits to making the turn, that, my friends, is you now getting that higher high. All right. So at a junction, the indicator comes up. That is you getting that first push, that break of structure. Right. When you get that break of structure, this has your attention. Ironically, with the app, with the scanner, I get an alert whenever the scanner it gets the break of structure. That's when it creates the setup for on the scanner, right? When the break of structure occurs. So that break of structure is the alert that says, hey, pay attention to me. Something could be happening. I haven't changed direction as yet. So you just wait. When it starts to slow down, that is giving you the indication like, hey, C is coming up. C is showing up. Because remember, I showed you before on one of the charts where price kind of shot up, but then it started to come down like this. This is price slowing down. All right. And that's confirmation number two. You're seeing price lose momentum. Why this means that it's slowing down is because anytime we're looking at this chart, it's based on time and price. If price did this, the time that it took to do this might have been just 15 minutes. But if you're seeing this happening and it took an hour and a half, then it's in no rush to actually go down. And that's slowing down. It's telling you, like, hey, this could be good. When you get when it commits to the turn and you get that, now you get that higher high. Now that higher high tells you that guess what we just got? We got that pattern that I told you exists everywhere and repeats itself all the time. You guys see what I'm saying? This, that little pattern that I showed you at the beginning of the call, that little pattern shows up right here. All right. But this is going to become more clear the more you got to draw it. You're going to have to draw it. All right. But let's see if we could find this in real life and make this whole situation make sense. We need price going down. All right. Let's try. Well, that looks like a weekend. That looks like a weekend. Leave. All right. Let's take a look at this right here. All right. So we have that's the high point there. Come on, arrow. Down, up. So high, low, lower high. Jeez. Lower low, lower high, lower low, lower high, lower low. Yep. Lower high. Boom. I'm not gonna draw out everything, but this is a lower high, lower low, lower low, lower high. This, for right now, this is a higher low. All right, that's a higher low. But now we gotta look and see, do we get a higher high? Nope, this one didn't go higher. Uh, kind of. So if we said that this was a higher high, right? And these are all higher lows, this is the higher high. At this point, this is where we will look to see, we will look for C. All right, we will look for C here. But we gotta wait for, you know what I mean, price to slow down and all that fun stuff. But what happened instead? This low is lower than this low. So we end up with a lower low. And this is a lower high. This is a lower low. All right. Something else happened. So if this here, this was a lower high, this is a lower low, but now this is a high, right? Lower low, high. We're now going to wait and see if this is going to change direction, then we need to get a higher low. This low is higher than this low, like barely. And we get a higher high, and we get a higher low. All right, so we would have gone on this higher high. Two things we could have done. All right, first thing, is there any imbalance here? Are there any gaps? All right, cool. This looks like a gap. But was that gap within a discount that we care about? No. All right, cool. Um, but these imbalances may not show up exactly the same way all the time, right? Something that we will get into a bit later is that there are different time frames. But what I will tell you is a lot of movement in one direction, that in itself is imbalance. All right. So that's like if everything is going great for you all the time, eventually, I mean, it's not sustainable, right? You're going to need to take a break. This is the person cutting trees just all the time. So what happens is within this area, just to put it simple, we'll just look at, see where about 50% is. And if I was to go on a lower time frame, they're probably going to have some gaps in there. Oh my gosh. Can I actually find this? Where was I? All right, here we go. Look at this. So this was a 50% area right there. And right here, we have that gap. And just about in that area that the gap showed up, right? Because remember, in the gap, like this is C, right? So we were looking to get the buy here. But the same thing that I told you about the car scenario, if we wanted to now get a buy in this area, then we needed to see price start to give us those higher highs within this area. So we go down on a lower time frame, even lower than what we were at just now. Right? So this is inside that area that we were just looking at. Right? So we're already in here and we're just looking to get the same thing that we were looking for before. So this is a high, lower low, lower high, lower low, lower high, maybe higher low, higher high. We do the same thing. About 50% of this right here. And our C in this scenario, because now we're looking at, geez, this goes up, this comes down, give us our C, and then we would have entered that trade within that area, and boom. So that's kind of like how that works. All right. Now, I know that me trying to jump between the time frames could feel like it really complicated things, but I just wanted to show you that to add some meat to what we spoke about at the very, very beginning. Right? At the beginning, all we spoke about was there is this pattern that exists. It gives you A, B, C, D. Whoops. We buy at C. This is C. The only way we can get to C is if B starts to go down. So B is a downtrend. This is B. C starts to show up when B ends. So the question was always, how do we know when B ends? When a downtrend stops going down. So when we no longer get those lower lows and lower highs, when we start to get instead of a lower high, if we get a higher high, then that's our first indication. That's that car on the road turning on its indicator telling us, hey, I might be looking to make this turn. But we still have to wait. When it slows down, that's us getting a higher low, which is this. We enter at the higher low. All right. So all of this right here, everything that I just showed you, all of that is happening at C. All right. You're going to get the skill eventually of how to do what I showed you in here. But for us right now in this class, all you need to know is you buy at C. This is just showing you what happens at C. All right. So we'll keep going over this kind of in different ways just so we get more clarity on it. All right. So on another call, we could probably spend the entire class just looking at this change of direction, all right? So the last thing that I will show you is this. I need a different color. This price started here. We went up to here. We came down to here. And then we went up here. So let me know if you see it. This is a demonstration, the simple version, which is just using the line for what I was showing you. This is the move on the chart where C is this area, and we had to zoom in so that we knew when it stopped going down. All right. But this white arrow that I just drew is what that overall pattern looks like. The same pattern that we talked about at the beginning. All right, guys. Let me start recording. But you can let me know